Hi and welcome to this week's edition of Macro Minutes. I'm your Head of Trading, Mark Gardner. Information summarised in this webinar does not constitute financial advice and is general in nature, does not take into account specific circumstances and should not be acted upon without your full understanding of your current situation and future goals. Okay, stocks in our universe this week. We have Sydney Airports, Oz Minerals and Pilbara Mining. So, Sydney Airports received a second revised cash offer of $8.75 stapled security. First offer was $8.25 in July the 1st and then $8.45 in August. Previous offers were determined to be not in the best interest of Sydney shareholders. However, the new offer intends to grant due diligence into the consortium to subject to entry into a non-disclosure agreement. Due diligence will be granted on a non-exclusive basis and is expected to take 4 weeks from entry into the NDA. If the offer still stands, subject to conditions of entry into a binding scheme agreement and the assessment of the binding offer by SID, SID's board will recommend security shareholders a vote in favour of the approval. Sydney share price increased 4.6% on the day of reporting that, ending the day at $8.37. So it looks like that'll go through there. Next up, we've got Pilbara Mining in the lithium space there. They had their second auction on their battery metals exchange platform, auctioning spot cargo of 8,000 megatons of spodumene concentrate with 5.5% lithium oxide. The highest shipment bid was 2,240 DMT, dry metric ton, or 2,500 DMT, including freight costs. Of $260. Expecting loading date in November. This represents a 79% increase in the value of the winning bid of $1,200 in their first auction, which was already well above spot prices at the time. The results stunned traders expecting a max bid of around about $2,000, with Chinese traders quoted saying that these prices almost all the profit margin is being squeezed out. Given the high prices, PLS expects to channel more sales through the BMX platform. It's increased about, I think it was, it increased around about the sort of 10% mark on the day to $2.50. It's since pulled back to about $2.35 yesterday, but it's underlying. It's been, it's been very well bid, that thing. I think about 6 to 7 weeks ago, it was trading about $1.40, that PLS. So it's going ahead in leaps and bounds there at the moment. Next up, we've got Oz Minerals. They completed an EM geological survey at Breena Plains, generating conductors at 3 locations, with the 4 kilometre long high conductance EM anomaly to be drill tested in October. Minotaur Alliance recently purchased the Breena Plains tenure, with Oz Minerals and other members of the Breena Plains Alliance able to earn 51% tenement interest by sole funding of $4.35 million. Additionally, a further 24% interest can be earned by the Alliance in the next 2 years for the additional expenditure of $4 million. Currently, Oz Minerals continues to fund all exploration to attain the 51% earning goal. Oz Minerals will hold a 35.7% interest in the joint venture upon completion. If they continue to fund all exploration costs in the following 2 years, Oz Minerals will hold a 52.5% interest, with Minotaur and other members of the Alliance holding a 47.5%. Their share price increased to 2% on the day of reporting. They got above $25 for the first time in a while, showing some positive price action after some general weakness. The copper price has also been a little bit better bid of late as well, so it appears to be out of the woods there. I think it got down to about $20.50 at one stage. Even though they reported great results over the reporting season. Rightio, we've got trading stock of the week now. So those of you who have been watching the stock market generally, you've probably seen tweets or social media or etc. about what's going on in uranium. We've been playing this uranium via Paladin. Unfortunately, we bought 42s on the 20th of August, and I think we're out of those at like 52 and 58 within about 6 trading days for about a 30% gain. It's now at $1.07, so missed out on some there. Those of you who are clever enough to hold on, well done. So I've basically gone through all the uranium stocks. Some of them have risen anywhere up to 300% over the last period. So Boss Energy was one that basically has lagged quite a bit. It's around about the, up about 130% mark, as you can see there on the chart. They do have a project called the Honeymoon Project, which is in Broken Hill. That's their major project. They basically announced yesterday that they had appointed someone to restart the mothballed mine. So basically, it was in mothball because the uranium price wasn't up enough, wasn't at a price enough where it was viable for them to produce. But uranium prices jumped from about $30 to $50. As one of the big hedge funds in the US, Sprott, has started trying to corner the uranium market. Guys like these Wall Street bets and things are onto this now as well, which I don't know whether that's a good thing or a bad thing necessarily, but I think there's a little bit of a bit of upside left to run in this, particularly for something that with Boss, basically they'll have their mine reoperational back up and running by about March next year. There isn't too many actual producers out there, particularly sort of, there's a lot of Australian listed companies, but sort of alligators in the US, etc. So look, these things might continue to go up. When uranium rallied about 10, 15 years ago from about $30 base, rallied to $140, the spot price per pound. So this is something that can run. Uranium really is the only thing that is a non-carbon emitting baseload electricity. So for countries who are trying to meet this Paris Accord, we're going to see nuclear become a bit of an option. So essentially, I think the EU about 6 months ago said that they might be changing the ESG rules, so nuclear qualifiers, etc. That's why trading department's been rolling around that Paladin trade, knowing that we're going to have an underlying bid tone. So didn't quite expect it to go this far, but look, it did finish the day yesterday around about 34. You'd probably try and buy in a pullback. Wouldn't be adverse to buying it on the run either, but obviously it's a high risk trade. Could easily come back, so obviously just know your risk profile there. You wouldn't be putting in a huge allocation of your portfolio overall. Rightio, stocks to watch. We've got EGG. They announced a fully franked dividend of 4.4 cents a share, going ex-div on the 22nd of September, payable on the 6th. The dividend yield of 4.83 at current prices. They provide marketing and communication services to multinational blue chip clients in Australia, the UK, US, including Facebook and Google. They had a 5-year record of revenue and EBITDA growth, performing strongly in financial year 21, with net revenue up 18% to 160 million. Attributed to larger contracts with their technology and online media and healthcare clients, with COVID-19 accelerating the adoption of technology in both recreational activities and workplaces. EGG experienced increased demand throughout financial year 21, acquiring the UK marketing firm McDonald Butler and Associates in that financial year as well. They continue to seek further acquisitions in the next financial year, and have hired a former Hotwire CEO as an advisor to assist in US-based acquisitions. This is one of the favoured ones of the funds. It can be quite thin, so worthwhile putting in bids behind if you're a fan of it. So it is one that does tend to go on a few runs. It's been a recommendation from the trading department in the past as well, which we've already hit price target on. Next up, we've got AP Eagers, or Eagers Automotive. They announced a fully franked dividend of 2.8 cents a share. They're going ex-dividend on the 23rd, payable on the 15th. Dividend yield of 3.3% at current prices. They're an automotive retail group that runs motor vehicle dealerships in Australia and New Zealand. Their revenue rose 13% to 4.6 billion by the looks, and then EBITDA rose 65% to 378 million, reflecting the market's recovery from the last year's reduced demand. This translated into an NPAT of 200 million from 11.8 million in the first half of the calendar year 2020, equating to an increase of 1,600%. Note that APE's management has not increased their inventory in preparation for future seasons of high demand. Freight costs have been rising due to increased demand for semiconductors, resulting in the costs that could impact APE's performance if that trend continues. So used car prices globally have gone through the roof because of this semiconductor shortage, but we are coming out of the back end of that. Typhoon season over in Taiwan. And I think they're rebuilding the factory that burnt down, that produced a very large chunk of the world's semiconductors. So new cars at the moment are, like an 8-month wait, I think, for some cars. Next up, we got Brickworks, property development investment group that also manufactures building products. Last month, they announced they expect EBIT for building products sold in Australia to be 35% higher than the previous year. At 44 million, which was in line with consensus. Brickworks' 39.4% shareholding in Washington Soul Pattinson, SOL, is expected to contribute to NPAT of 64 to 72 million. After Soul announced that they expect NPAT to reach 316 to 336 in 21, rising by over 85%. Consensus NPAT down 11% from the financial year previous. Revenue up 2%. EBITDA at 418 million, up 49%, and EBIT 342 million, up 66%. Due to COVID impacts in New South Wales and Queensland, Brickworks also announced last month that their manufacturing operations have been temporarily limited. However, these impacts have not influenced their financial year 21 performance that reflected the temporary rebound of the construction sector. While their manufacturing capabilities are temporarily curtailed, the growth of online retailers led to further construction projects to develop and distribution centres for Brickworks going into the future. Rightio, now we're looking at the week ahead. So we've got Aussie unemployment yesterday. We got US retail sales, US CPI. So next Tuesday, we're going to have the RBA monetary policy meeting. That'll be released. Just a minute to the meeting. It'll be more so about how flexible they are on the tapering, I would imagine. We did have a horrible employment number yesterday, down 146,000. The unemployment rate did come in at 4.5% though, because the participation rate dropped. So essentially, we're going to, that number will be very volatile going forward. We've got Thursday next at 4 a.m. We've got the FOMC projections will be released. This report includes their projection for inflation, economic growth over the next 2 years, a breakdown of individual FOMC members' interest rate forecasts and the dot plots, which has previously been a bit of a disaster, but I'm sure they'll have a fitting explanation this time around. Then their statement will be released after that, and I think they generally also have a Q&A. We do have the options expiring in September, which has previously been the trigger point for sell-offs in this seasonal weakness. So that's something to be wary. So over the next week, if there's any sort of bearishness overall. So thank you for attending the Macro Minutes this week, and we will talk to you again next week.